Welcome to our latest series of Insight videos where I'll be considering UK property related taxes and how these may impact upon you, especially if you're looking at moving from Hong Kong to the UK. So we'll consider the main UK relevant property taxes that you need to be aware of. We'll consider how you may be able to sell your Hong Kong property while minimising UK tax, as well as minimise UK tax on the purchase of your UK property. This will help you plan and structure the sale and purchase of your properties, making sure that you don't pay more taxes than you need to. Stamp duty is payable by the purchaser of a UK residential property. Stamp duty rates change frequently, so it's worth checking the HMRC website or looking at our online stamp duty calculator. A further 3% stamp duty is payable if you are buying an additional property. An additional property means that at the time of completion, you own 2 or more properties anywhere in the world. You may be exempt from this if your new property is intended to be your main home and you have sold a property that was your main home within the previous 3 years. Alternatively, you may claim a refund if you subsequently sell a property that was your main home within the previous 3 years, within 3 years from acquiring your new property. This is particularly relevant for anybody who is looking to sell their home in Hong Kong and move to and buy a property in the UK, because the sale of the Hong Kong property and purchase of the UK property is unlikely to happen in tandem. An additional rate of 2% is payable by non-UK residents when buying UK residential property. For the purpose of residency, this means if you are resident in the UK for 183 days or more in the 12 months before or after your purchase. Rental income on UK residential property is chargeable to income tax, regardless of whether you are UK resident or not. The rate of income tax depends on your level of UK income. However, this may not be available in certain circumstances. For example, if you are a UK resident claiming the remittance basis of taxation, or for some overseas residents who do not hold the full British passport. Thereafter, the banded rates are 20, 40 and 45%. Certain allowances and deductions can be made. However, mortgage interest relief is now restricted to a 20% tax credit. Capital gains realised on UK residential properties by non-UK residents have been chargeable since April 2015. Non-UK residents who have the full British passport and also UK residents who are not claiming the remittance basis of taxation will have access to the annual exempt amount for capital gains tax. Thereafter, the rates chargeable are at 18% and 28%, depending upon the tax bands they fall within. Capital gains tax will not be chargeable on a property that you have occupied as your main residence for the proportion of time that you have actually lived in it. Also, the final 9 months of the ownership of the property will be exempt from capital gains tax, regardless of the actual use. So, for example, if you own a property for 10 years, you live in it as your main home for the first 5 years and then let the property out for the remaining 5 years, the first 5 years will be exempt from capital gains tax, as well as the final 9 months, even though you were renting it out. Inheritance tax is chargeable on death on the value of UK residential property, regardless of whether you are UK domiciled or not. The first £325,000 falls into your nil rate band and will be charged at 0%. Thereafter, a further £175,000 may be available through the residence nil rate band if you are passing your main residence on under your will to a direct descendant. Mortgage debt that is taken out to acquire the property can also be offset against the value of the property for inheritance tax purposes, as long as it is repaid upon death. Previously, a simple planning technique was for non-UK domiciles to acquire UK residential property through a non-UK company, typically out of the British Virgin Islands. The benefit of doing this was because upon death, it was shares in a non-UK asset that were passed on to the descendants as opposed to the UK property directly. However, legislation introduced in 2017 has made such planning ineffective. If you own a UK residential property through a company, then rental income and capital gains are subject to corporation tax instead of income tax or capital gains tax. One benefit of a company ownership structure is that mortgage interest relief is not just limited to the 20% tax credit that individuals receive. However, a potential downside of a company ownership structure is that certain allowances may not be available, such as the personal allowance for income tax relief, the annual exempt amount for capital gains tax relief, and also private residence relief. Another tax that is related to owning UK residential property through a company structure is the annual tax on enveloped dwellings. This tax is applicable where a property is worth more than £500,000 and it is owned through a company structure. There is one key exemption to this, however, which is where a property is let out on a commercial basis. Therefore, this tax particularly targets the ownership of UK property through a company structure where the property is used for personal reasons.